Does it ever feel like the whole dream of owning a home is just for people with a classic 9 to 5 job? Well, you're definitely not alone. I mean, for the millions of us who are freelancers or entrepreneurs or part of the gig economy, that dream can feel, well, locked. Like there's a door, but you just don't have the right key. So today, we're going to crack the code on non-traditional mortgages. They might just be the lifeline you need when your career path is anything but a straight line. All right, let's get into it. All right, so here's the real issue, and it's a super frustrating catch-22, right? You've got the income, you've done the hard work of saving for a down payment, but you don't have that one little piece of paper that lenders just love, the W-2. And for a lot of traditional banks, that's it. It's a hard stop. So what are you supposed to do when your success just doesn't fit neatly into their little boxes? And look, this isn't just some annoying paperwork problem. It's a whole system that is fundamentally stuck in the past. The traditional mortgage process, it was basically designed for this old school world where everyone got a steady, predictable paycheck from one company. And frankly, it just hasn't caught up to how millions of us actually work today. And this isn't some small niche issue. No way. We're talking about millions of people building businesses, creating jobs, driving the economy. And they're basically locked out of the housing market. It's a huge, huge barrier to building wealth for a massive and still growing part of our workforce. But you know how it goes. Where there's a big problem, the market eventually comes up with a solution. And in this case, the financial industry's answer is something called the non-qualified mortgage, or non-QM for short. So what exactly is a non-QM loan? Well, think of it like this. It's the workaround for the modern worker. It's a mortgage that's specifically designed for people who don't check all those traditional boxes. It's the key that can finally unlock that door to homeownership when the standard one just won't budge. And hey, these loans aren't just some tiny niche product anymore. It's a booming market. And why? Well, because they're solving a real pressing problem. They're for everyone from successful small business owners to people with a high net worth whose income might be a little irregular or unconventional, but is absolutely solid. Okay, so let's check out what's on the menu. The world of non-QM loans isn't a one-size-fits-all kind of deal. It's more like a whole range of different options, and each one is tailored to a specific financial situation. Let's take a look at a couple of the most popular ones. First up, you've got the bank statement loan. And this thing, it is an absolute game changer for entrepreneurs. Instead of digging through your tax returns, which, let's be real, are often designed to show as little taxable income as possible, thanks to deductions, lenders look at your actual cash flow. They'll look at 12 or maybe 24 months of bank statements to get a true picture of your business's financial health. Next up, we have what's called an interest-only loan. Now, for a set period of time, you only pay the interest on the loan. The upside? A much lower monthly payment at the start. And this is a really big but, your loan balance doesn't go down, not one bit. You're basically just treading water, not actually making any progress on paying down the debt itself. Then there are hybrid adjustable rate mortgages, or ARMs, as you'll hear them called. So with these, you get a fixed interest rate for an initial period, like say 5 years on what's called a 5/1 ARM. But after that, the rate starts adjusting based on the market. Now, this can be a smart move if you're planning to sell or refinance before that rate changes, but make no mistake, it is a gamble. You have to be ready for a potentially much higher payment down the road. Okay, so we've talked about the good stuff. But with all this flexibility comes some pretty serious risk. And when we're talking about your home, the stakes just don't get any higher. So let's shift gears here and take a really careful look at the potential downsides. So one of the biggest dangers is something called payment shock. Picture this. You're cruising along for a few years, your payment is totally manageable. Then that introductory period on your ARM or your interest-only loan ends. Your rate resets to whatever the current market rate is, and bam! Your monthly payment can suddenly skyrocket. And I'm not talking a small jump, we're talking hundreds or even thousands of dollars more per month. This quote right here, it perfectly sums up another huge risk, negative amortization. It's a scary concept. Basically, it happens when your monthly payment doesn't even cover all the interest you owe for that month. So for example, let's say the interest due is $2,000, but your required payment is only $1,500. That extra $500, it gets tacked right back onto your loan balance. So get this, even though you are making your payments on time, your debt is actually getting bigger. It's a really dangerous trap to fall into. So let's just break it down side by side. You've got payment shock, That's the sudden, huge jump in your monthly bill you'll see with ARMs and interest-only loans. And then you have negative amortization. That's when your debt actually grows, and you find that in some of the riskiest loan products out there. These really are the two monsters lurking in the shadows of these mortgages. And trust me, they can do some serious damage if you're not ready for them.
Okay, so we've put all the benefits and all the risks out on the table. What does this all mean for you? I mean, how do you navigate this world safely and make sure these tools work for you, not against you?
Really, it all boils down to one thing. Knowledge is power. These loans are incredibly powerful tools, but they are absolutely not for everyone. And, just like you wouldn't fire up a chainsaw without reading the safety manual first, you should not sign on the dotted line for one of these mortgages until you understand every single detail in that contract. So I want you to have 3 non-negotiable questions to ask any lender you talk to. Seriously, write these down. Number 1, what exactly happens when my initial period ends? You can even ask them for the recast date. Number 2, and be direct, can my loan balance ever go up, even if I make all my payments? And number 3, what is the absolute maximum worst-case scenario for my monthly payment? And don't just take their word for it. Get clear answers in writing. And remember, the burden isn't 100% on you. Lenders have a legal responsibility here. They have to make sure you can actually afford the loan they're offering. This isn't the Wild West like it was before the 2008 financial crisis. There are rules in place now that are designed to protect you, the consumer, from predatory lending. And all of this really brings us to the big final question, doesn't it? As the way we all work continues to change so dramatically, the way we buy homes, well, it has to change too. So the real question is, can we build a system that's both flexible and fair? A system that opens the door to homeownership for everybody without putting individual families or our entire economy at risk? That's a pretty powerful thought to chew on.